Okay, welcome to Supporters Fund Ask an Angel. I'm your host, Jeffery Potvin, and let's welcome our investor for today, and that is Matt Fates. How are you, sir?
I'm doing well. How are you?
Very good, very good. We're excited to have you on today, so thank you again for joining us. And the best way for us to kind of kick this off and to start is if you can share a little bit about your past background with the multiple VCs, and even before that, all the great things that you've done, kind of where you're at today, and then one thing about you that nobody would know.
Okay. So I was a computer science and economics undergrad and loved writing software, but was self-aware enough to know there were many people who were way better at it than me. So I initially wanted to go in technology business, and the easiest way at that time was technology investment banking. Worked at Alex Brown initially, and worked on some really interesting companies, some of the early communications equipment companies and software companies in the mid-90s. And then found my way to venture in 98 and joined Norwest Venture Partners, which today is a global firm. At the time, it was East and West Coast offices in California and Boston. And it was obviously a very fun time, right? Lots and lots of new startups, lots and lots of innovation going on, lots of, the Telecom Act had disrupted things in 96. And so there was all this new fiber being laid, all this new communications equipment being built, everyone thinking, the internet was going to sort of change the world instantly overnight. And obviously that built up to the dot-com crash, where they were right. It's just, it's going to take a lot longer than overnight. And so lived through that cycle, ended up joining another venture firm a few years later called Ascent Venture Partners, where I still am today. And at Ascent, we focus on early stage B2B tech companies, with a little bit of revenue, starting to scale. And we really try to work closely with a small number of companies to help them transition from sort of successful startup to scaling, full business, and so on. We've had the great fortune to work with some great entrepreneurs, great companies. Some have gone public, many have been acquired. We have an active portfolio of about 15 companies today. Not many people know that when I was young, I actually lived over in London and went to an English school and had to wear knickerbockers as a uniform every day. So a particularly ugly uniform.
Oh, that's actually pretty fascinating. So is it now a fear of yours that you will never be caught wearing those ever again?
Yeah, it was the last time I put on a pair of knickerbockers. Certainly the other schools around London would make fun of us.
Yeah, I can imagine, especially back then. I think the world was a lot tougher then too, right? So they probably didn't look at it as probably didn't see a knickerbockers or thought it was something completely different. But yeah, it sounds like it would be a interesting engagement.
Yeah. It was actually a neat school, very international, kids from all over the world, but horrible uniforms.
Well, you learn from it, I guess, and I'm sure you had some great memories from the opportunity regardless.
Absolutely. Living abroad as a youngster was actually very valuable, and getting to see the U.S. from the outside and sort of understanding others' perspectives was, I thought, a very valuable experience.
I would agree with that. I think that it really shapes you as an individual, as one being open to different cultures, but I think it also balances out your drive going forward, the things that you're focused on, reduces that fear of what is the rest of the world doing, and probably more empathy towards other minority groups, because you're in a different culture and you are a minority and you're adapting and all of those things. So I'm sure it was pretty valuable.
Yeah, no, absolutely. And I think, most Americans take a lot of pride in being American, but I think it helps see that, there's some issues too. Right? Far from perfect. And there's lots of things that could be done differently, and you can learn from other countries, other cultures, et cetera. that might do different, might do different things, different ways that are actually better.
Agreed. I've been, I guess as a footnote, I've been to over 50 countries and backpacked, lived different angles through it. And I can tell you that it certainly opens your eyes up to where cultures are, where their businesses are at, where their startups are at, where the economies are good or bad. You learn a lot quickly through the way people engage with you as you travel, and just as you see how things are working there. So it's a pretty fascinating overall experience, and I think living there or not living there, it's certainly pretty amazing to be able to experience that.
Yeah, absolutely. Important to see the world if you can.
Yep. So to kind of go back to some of the things that you talked about and kind of where my interest and excitement is, because we work with a lot of different groups from Schulich MBA students, placing them into business and figuring out what they want to be one day when they kind of grow up and mature in business. But what's interesting is, I would say 10, 15 years ago, maybe 20 years ago, there was very little interest in venture capital. I don't think a lot of people understood it. Probably still don't understand it today, but there wasn't a lot of interest. And what I found fascinating about what you've accomplished is that, one, you did this a long time ago, and then you got into a very rare space 20 years ago. But it all started as being an analyst, and then you progressed from there. So how much of that analyst experience did you get in? Of course, when you're in banking and everything else, I find that they become the first kind of forerunners into investing in early stage companies because they seem to get business. They understand the numbers, the metrics. So there's a lot of that pulls to it. But what got you to decide to go in as an analyst while you were a computer science person, which is obviously total ends of the spectrum, coder versus money guy? But doing that analysis, working through that, and then deciding to take that leap into venture capitalism, how much of that 2 years experience or 2.5 years that you spent there, how much did that really change? And what was the driving force that said, I got to get into this venture capital space?
Yeah. Well, I was lucky, even in the undergrad, and you were right. Back then, venture capital was almost never in the news. Most people didn't know what it was. It was really only something that the large money managers of the world had some exposure to, right? And they'd carve off a tiny piece of their portfolio to put it in this risky asset class. But I went to a university where the gentleman who ran the endowment was a real thought leader and was very aggressive about moving money out of just stocks and bonds and into alternative investment vehicles. And he also taught a class where he would bring in managers from the different asset classes. So hedge funds, real estate, timber, debt, and venture capital to his class. And I was able to take that seminar from him. And his name's David Swenson. He just recently passed away, but really a respected leader of the endowment management world. And that's where I heard about venture capital for the first time. And it just sort of sounded like something that it was a really good combination of my interest in technology, but also in kind of, business and having portfolio, being able to work on more than one thing at a time. So that's kind of why it stuck in my head. And in going into the investment banking analyst program, right, as you said, you learn a lot about business, you do a lot of spreadsheets, it's a great initial job in that you are exposed to a lot of work and you have to learn very quickly. But I also knew it wasn't what I wanted to do long term. It was way too transactional. Whereas what I loved about venture was that you really got to know the teams. It was more like a 5, 6, 7 year relationship, not like a 3 or 4 month relationship. And, if you could really help them and kind of, help them achieve some of their goals, you could really, to some degree, become like an adjunct part of the team. Even though they're really obviously the ones driving the business, you could have a much closer relationship than you could as a banker. So that's what drew me to it. It also late 90s was a time where the industry was expanding, growing. It was starting to become a little bit more well known, and so it was a reasonably good time to get into the industry. Right, firms were actually hiring people at that time.
And then when you kind of made that leap in and you made your way into the first firm, Was it a tough find? Was there a lot of them out there, or you were kind of refined down to a few, and based on your knowledge and background, it kind of helped you get into that, propel yourself in? Because being a developer, one, very few venture capitalists understand how code works or how tech works in that capacity, especially back then. So I'm assuming you brought in a really good understanding of that base, and that was a need that you could fill, that was probably super helpful. And it sounds like, just the way you talked about this, that you are kind of a hands-on people person. So it makes a big difference in making an engagement work and being able to be effective through that analyst growth, because you get to work with these founders and grow with them, versus just, sprinkling VC money all over the place and hoping it sticks. So I think a lot of that carries a lot of value too. And is that kind of how you got yourself moving and perpetuating forward?
Yeah, no, I think, having a technical background is certainly helpful. A little easier to have, an in-depth product conversation with the CTO or, a product lead, when you generally understand how coding works and how software architecture works and so on. So yeah, certainly that was very helpful, but I think it was mostly just having a real passion for technology and being interested in it, and interested to see, how can it sort of solve problems for businesses, for people. Obviously, as you start looking at lots of deals, you certainly learn that some aspire to solve problems, but they don't necessarily resonate with customers, and others do. And so I think I was also lucky in that my first venture job, I had a really great mentor, a gentleman named Ernie Parizeau, who was the partner at Norwest Venture Partners that I work for. And he gave me the opportunity to sort of go out and really source deals and do research and try to help understand some of the new technology trends that were going on. But he also would spend time and, sort of share what he had learned, and he'd bring me to board meetings, and I could sort of observe him interacting and sharing advice and working with companies. And so having that sort of mentorship, having that sort of opportunity to some degree, have him bring me along for those first few years of my career was extremely valuable. So I would certainly recommend any young people getting into the industry to try to find someone like that to work with. It's going to be a huge advantage.
No, that's very valuable insights, because again, I think a lot of times people love the idea, want to get into it, start being analysts inside a venture firm. Now it's very competitive. Being able to get into a venture firm and be an analyst is probably the toughest job you'll find, because of the fact that there's many analysts, but not enough roles, because again, it's a pretty tight ship on a firm side, because they're managing, sure, $50 million, $100 million funds, but there's a lot of, there's only usually that 2 and 20. So we're kind of working against until you start getting exits. So everything's a pretty slim team, but once you're in there, I'm sure there's a lot of great mentoring and opportunities. But you mentioned one thing, which was around the trending side. So as you've kind of worked through these two different groups, is it common that a venture firm is really staying in tune with the markets and wanting to know where things are going? Like you kind of seen with, what's the product called now? The chat one, Clubhouse.
Yeah.
So that one kind of just came out of nowhere, and then all of a sudden was a billion-dollar company and only running on Apple. But the trends were that communication may have been going into stagnant mode, and they needed something. And then this group came out of nowhere and started to kind of tear up the market. And then now the reverse is happening. They're kind of, I don't know if it's still happening, but sagging down in numbers because of pandemic ramping up and people finding more time to get to offices and less time, I don't know, flipping their day through conversations and jumping into Zoom calls and everything else. So maybe that was just the right trend, but it was the right trend at the time. Who knows? But how have you guys looked at trending? And has that been going on since day one, that you're always trying to find that company that's bringing something a little bit more different and fantastic to the market, and you're jumping on them? Or do you care more to see traction, value build up before you would look at them as being a potential investment?
Well, yeah, certainly I've always been a believer, and this was instilled in me at Norwest, and it's definitely something we've continued to send in developing a thesis and doing research and trying to find interesting companies. It's not the only way, right? It's certainly not the only way, but being proactive and sort of having a few, you call it sort of active themes that you're excited about, interested in, doing research, meeting companies, going to events, reading blogs, listening to podcasts, trying to, be really smart, trying to get up to speed, trying to know just what's going on at the cutting edge, and figuring out, who are the real thought leaders. I think that's very smart, because that way, when you meet with a company, you can bring value to that conversation, right? You know who the competitors are, you know what the market dynamics are, you've been developing some feel for what customers, get excited about, right? And that's a much more engaging conversation for an entrepreneur than when they're teaching you, all about their market for the first time. So I think doing proactive research, around theses is definitely an important way of sourcing deals. But you also do have to be reactive as well. Sometimes, many times, people will come bring a new idea to you that you hadn't yet really had time to think about and you hadn't really focused on yet. Maybe someone in your firm did, maybe someone has, and you can pull them in to help you kind of ramp up quickly. And that's something we certainly always have done, is thought about when you hear a compelling pitch, is to think about, okay, who do I know that can help me evaluate this? And who do I know that's really smart in this area that might be able to give me some time and help me get up to speed quickly, figure out what the right questions are to focus on, and so on. But I always thought about sourcing in kind of a fairly simple way. It's either them, meaning it's sort of your network, people you've worked with before, people you've met, right? You always should be cultivating your network. And hopefully those people will think of you favorably when they're joining a company or starting a company. Then there's the people that you go find, right? You go find that you either know them or you go find them. That's the proactive work. But then the third category would be making it easy for them to find you. And again, that's doing things perhaps like this, or hosting your own events on specific topics and bringing a community together to discuss that topic, or just trying to make yourself accessible to that next generation of entrepreneur. So I think doing all three of those things is very important for making sure you're seeing, sort of a diverse set of deal flow.
So when you kind of talk about kind of working all of this, it makes me think of, I'm assuming baseball is still kind of the American lifestyle. It's part of their big culture side. Kind of feels like you're building a farm team up. You're working, nurturing them before they bring them to the majors, which is when you guys are going to invest. You have your analysts going out to all of the farm teams across the U.S. looking for best deal flow. Then they're working the deal, understanding how they're going to work and operate. And then once those are kind of fed into the system, you guys will then decide which one of those on the farm team are going to work their way into the majors, which is getting an investment from you guys. But it's kind of all staged through. You're working with these companies, learning about them, bringing in researchers, bringing in outside talent that can evaluate and give feedback that you may not have, sticking within your thesis, which is focused on if it's fintech or whatever that investment thesis is, while bringing in the right players to validate it. And then now you've got them in the game. They're not playing yet, but you're going to throw them out on the bench, get them off the bench and into the field. And that's where you're going to start coaching, working a lot more with them, putting more dollars into those companies and get behind them. Is that a fair analogy?
Yeah, I mean, I think but of course, in venture, right, you might have to take it all the way to, I can't remember, I think the name of the film was something like $1 Million Arm or something, where the scouts go to India. Yep. Right. They had developed a thesis that in a country of like 1 billion people, we're going to find some good pitchers. and it ends up working out, of course, because, cricket is one of the big sports that they love there. And so that's more like the trying to, develop a thesis around, okay, this looks like it could be interesting. I mean, clearly in venture, there's enough firms out there today. There's so many more now than there used to be. There's probably some other people who have a similar idea, but still, you can be one of the investors that goes deep and gets smart. So it's more, you're thinking outside the box like that while you're also paying attention to the standard farm system of deals that come into you through your network. And I would say, I mean, when I got into the industry, there were certainly, I don't know, there were probably a few hundred active venture firms, but the total employment was, I don't know, 5,000, not a lot of people. Like a relatively small company would be bigger than the entire venture capital industry in the 90s. Today, it's definitely a lot bigger, but it's still not that large maybe it's 20 to 30,000 people, but it's still, relatively speaking, there are many companies that have more employees than that, right?
For sure. Well, you're looking at a venture firm that could be $100 million fund and have 8 to 11 people working at it.
Or less, or less.
You're like, this is insane. How do you manage this? But it's all automation. But I think the best way to look at it is that when it comes to finance, you're always refining your finance model to make sure that you're as lean as possible, because at the end of it, you're deploying a lot of capital, but you also have to run and operate it as a business, which means you have to be making money. The people working in that business have to be making money. And that's what's going to drive the whole thing forward. So I agree that there's small numbers compared to any company that $100 million in revenue. They're looking at, 4,000, 1,000 people, 100,000 people. Like there's whatever the number can be if it's product or whatnot. But yeah, there's a huge difference from big business to deploying big capital. So
yeah. Well, and people hear $100 million fund and they think, oh, that's a lot of money, and it is. But that money is supposed to be invested. It's not, doesn't go to those partners, doesn't go to the people who work at the firm. And I think you typically see, if you're trying to, let's just say you're trying to do 25 investments out of a $100 million fund, right? And you've got a team of, 3 to 5 investment professionals. You've got to, pay your rent. You've got some technology expenses for the software, the computers, and everything that you use. You got all the healthcare. It ends up being like there's the salaries of those partners is not necessarily going to be all that. It's going to be good, but it's not all that exciting. So the incentive is all on the investment side, and having that carry, having that upside on the investment side. And that's good, right? That creates good alignment with the people who invested in that fund, in that these GPs really only going to make good money if they make good investments, right? And there's good returns. So I've also, and I should have mentioned this up front, Jeff, is that I also do some angel investing now, which has been a lot of fun and really does allow me to sort of focus on the early stage. And so I've gotten involved with some of the sort of strong angel groups in Boston as well, doing that. The difference there, of course, is that it's, there it's just your own money, and there it's just, and what I love seeing today is that I think angel investing is becoming more and more accessible. Whereas, 10 years ago, you probably had to be able to write, 25, 50K checks minimum. And if you wanted to have a diverse portfolio, you wanted to be doing 20, 30 plus deals. Like that adds up to a fair amount of money that a lot of people didn't have. Today, I think there's a lot of ways through AngelList, through SPVs, through other methods where you can write much smaller checks of more like $3,000 or less. And so it doesn't take as much to build a diverse portfolio and participate and start to build a bit of a track record as an angel investor. It's still real money, but it's not hundreds of thousands of dollars, right? So I love seeing that. And I think what it does is it allows people who are, working in startups, working in technology at the sort of forefront of a lot of these new trends, they can actually participate as investors, which I think is very cool.
And I wholeheartedly agree with that. I think it's amazing that, the financial structures have been challenged, set up a little bit differently, opening up more to the publics and not always about accredited investors. I think the risk level goes up a lot higher. But I think from using this as a method or a percentage, if it's 10% of your investment or whatever it might work out to as a startup, I think it's a great vehicle to certainly test and look at doing. One thing that's interesting for me is that when I looked at from all the years that I've been investing and working with companies, I've tested small, medium, large, and now you've got even smaller that you can do. And I started to think, when you work on the metrics of it, having a diverse portfolio is great, but having a diverse portfolio of $3,000 in a $2 million company and it sells at whatever in say 5 years, it sells at 30 million or 50 million. It doesn't go where you want it to, but it transacts. Is that the outcome that you're looking for? And, that minor change, maybe it's now worth 10 grand or something at that component. Was that worth the effort, time, and 3 grand? Or do you kind of look at this from your thesis standpoint and say, what, can I invest more in 4 great companies this year than invest in 40 companies and take such a small minority position in them? And I'm diverting my risk everywhere, but I'm also not really focused on the gains and focused on that company and specifically on helping that company succeed. So I kind of look at it as maybe it's too broad and investors are looking too broad. Now it does help, but on a cap table, it also doesn't help very well having 400 investors at, 3 grand. So how do you, maybe they're a certain focus, maybe another focus is trying to find investors that come in at larger portions. One, it helps them move quicker to cleaner cap table, but also position wise, I think it gives you as an investor, you're eating a lot more risk, but at the same time, the gain is a lot better too as they move forward, and you've got a lot more that you can help the company with.
Yeah, no, I certainly, if you do move into angel investing, I think you should be thoughtful about and purposeful about what your approach is, right? And I know some folks that are very disciplined about, focusing on a specific type of vertical or a specific thesis they have. It might be around, crypto, or it might be around data analytics, or it might be right. And they just want to do that, and they want to go very deep. And in those circumstances, I think it does make sense to kind of be a bit more focused and make fewer bets, and perhaps they can be a bit bigger. And then there are other folks, and I agree with you, it should never be a huge percentage of your personal portfolio, but if you really enjoy doing it, there's other folks who just want to back rate entrepreneurs, and they don't focus as much on necessarily the industry. They want it to be something that can grow rapidly if the right people are making progress and so on. So I think as long as you're purposeful about your what your approach is and your intention, and then you kind of stick to that and hold yourself accountable, then both methods can work. But you're right; you have to be honest that if you're just making lots and lots of bets, you're basically buying an index, right? And is that really the best way to invest in sort of an angel seed capital type index? I'm not so sure, because if you get lucky and there's 1 or 2 massive home runs in there, it can make up for a lot of stuff. But overall, the average angel investment loses money. So you don't want to be, you don't want to be at the average, right? So.
Nope, average doesn't win in this game.
No, it does not.
It doesn't help you. And it's interesting that you go to the average numbers and things like this. And I kind of want to pick your brain a little bit on the VC side. Because I think there still is that misunderstanding of where a venture capitalist come in before an angel. And maybe you can share a little bit about where a typical VC would come in as an investment. When's a good time to interact with a VC if you're interested to reach out to them? And then again, kind of summarize that with where the angel side fits in, or where you see your side fitting in. And then I kind of want to dive into some metrics around the two, but maybe share a little bit about that, please.
Sure. Okay. Well, so starting with the venture side, I mean, venture, there's now so many more firms, right? There and there's pre-seed, there's seed, there's Series A. So you have lots of different stages, and what it means is that yes, there's certainly a lot more capital. There's a lot more people to potentially talk to, which is great. But it also means you really should try to do your homework around finding ones that are the right fit, that invest in your industry, invest in your stage, that have sort of available capacity. And then, I try to always advise entrepreneurs, try to take a shotgun approach. And I mean, try not to take a shotgun approach, use a rifle approach, right? Come up with the sort of dozen or so most attractive investment partners for you at the various venture funds based on what they say about themselves, the investments they've made, where they're writing about in their blog or whatever. And it does take some more work, but I think that if you can do that, it's like account-based marketing, right? You know a lot more about them. You can reach out to them, hopefully through your network or in a much more intelligent way than if you're just sort of, to some degree, blasting the whole venture universe. Anyone that you think might be an investor, most people are just going to ignore that as noise. So really trying to be targeted, and to some degree, you want to raise your A round, or you want to start raising your A round as soon as your seed is done. And I don't mean like lining up commitments, obviously, but I mean identifying who are the best Series A investors for my company, and how can I start to build a relationship with them? And they can track my progress, right? And you could say, I'm not raising capital right now. We've just closed our seed. We've got 18 months of runway, but this is where we are and this is where we want to get to. And often, the right VCs will want to engage in that conversation, and they'll want to track you. Because for them, if they see you making really nice progress, they may want to preempt the process, right? They might want to sort of get to you before everyone else does. So that's, people want to take an early look at good deals when they can. So my advice on venture is start as soon as your prior round closed. You should be thinking about who are my ideal investors and building that list and figuring out how to take your time to get to them the right way. For angels, again, the angel universe has grown dramatically. There's now lots of individual angels. There's lots of angel groups. I do say I feel like some of the crowdfunding stuff is a little scary to me, and just that it feels almost too retail, too much broad exposure. But if you're working alongside, if you join if you're trying to get in front of angel groups, again, it's the same sort of thing. It's networking to find a member that you might have a connection to, someone knows someone, or whether you're using your school network or the company you used to work for network, but just trying to get introductions to angels and angel groups. It's similar, but it's a little different. And angels are good in that they'll generally make decisions more quickly. They'll obviously write smaller checks, so you should have a much lower target. But they can still be very helpful. I mean, I'm not the first one to say this. I think it was one of the guys at Launchpad that I heard this from, but it's absolutely true in that in venture capital, you have a lot of money, but you have a very limited number of people hours, right? You have a few partners deploying a lot of money. And so they have to be really careful about how they spend their time. When you think about the angel community as a whole, they don't necessarily have a huge amount of money, but they have there's a lot of people, right? And so if you can figure out who are the angels that care about what I'm doing and can be helpful to me, that's almost more important than how much capital they're going to give you. I mean, hopefully you're only raising, $500,000, $1 million, $2 million or something in the early days from angels. And that's usually not too hard these days. But you're looking more for the ones that can actually be helpful to you, help you as advisors. They know your industry. Maybe they can help you identify who the right VCs are for the next round. Things like that, right? Maybe those folks have been entrepreneurs in your space before and have had some success. So, and I think, angels will come in at almost any stage, frankly.
Well, I think that may be so, but I think probably majority of them that are angels are coming in before that seed because the value gets too high, and then they look at it as being not worth their dollars. But
yeah, I mean, I think that's right. I certainly see some that continue to look at later stage deals, but you're right. By far, it's more common where the early rounds are angels and these sort of micro funds, and then you kind of graduate up to the venture fund.
And don't get me wrong, there's a huge opportunity for angels to go into a series B, C, and D because they want to balance their portfolio as well, right? They want to make sure that if they're not going to get the success on the early stage companies, then they're going to get hopefully one of them on the more advanced going to market SPAC or whatever it might be position so that they can gain a quick dollar and then keep investing in the early stage companies as well. So I do.
That's right. That's why I mean, I think you should just be intentional around. Are you someone who's going to, again, your only criteria is I just want to back really good entrepreneurs in good markets? And if so, then I think you can look at any stage and in the industry. Or you're going to be someone who's very specific about, I know other people who say, I only write first checks, right? I don't do follow-ons. I only do the very early stage deals, and I only write first checks. And I do it so that I give myself the best chance at getting 100x outcome or whatever, right? So as long as you have a strategy and you're sort of thoughtful about it, I think that's what makes sense to me versus the just sort of reacting to things that show up.
Agreed. And it makes a lot of sense in this kind of realm of early stage investing is that a lot of deal flow makes a big difference. And this goes from angel side or VC side. And how much in the VC side and you've done the same on the angel side by working with angel groups in the Boston area, how much of that access to deal flow has helped you refine the types of companies that you invest in, even though it is segmented to specific companies at that early stage and specific outcomes of how your fund is investing or the VC that you'd be running? So did you see that there's a fine balance? Because top of funnel all the way down, you're kind of probably way closer to the bottom of the funnel. You're down to like 5 or 10 companies a year that have been scrubbed to get to that position. Are you believing that that's the best mix that you're going after? And if you didn't have the top of funnel service that was going on and feeding you, do you think it would be a lot tougher space to be part of, and that these groups are really refining the best and getting them in front of you?
Well, absolutely. I mean, so one of the groups I work with is called TBD Angels in Boston. And we've been talking a lot about this, right? We have a group that's now roughly 200 people. And so there's a lot of deal flow that comes in from the different people. And how do you efficiently evaluate those and quickly figure out which are the ones that are worth spending time on? And we certainly have not perfected it, but it's something that we are talking about a lot. Like, how do you leverage the wisdom of the crowd to zoom in on sort of the best of the opportunities that come in? And I think there's a real, it takes real effort. It takes real work. I mean, having great deal flow is critical to obviously end up making good investments, but just having a huge top of the funnel, it can become overwhelming, almost paralyzing, right? If you're getting 100 deals a day, there's no possible way you could, as an individual, process that. It's just overwhelming. And so that's why I think developing a criteria where things that fall outside of that criteria, even if they're good, you set them aside. And then for the ones that do fit the criteria, figuring out how do I quickly, and maybe it's by leveraging my network, maybe it's by working with a small team of like-minded people, maybe there's different strategies, but how do I take the ones that actually fit within the criteria and distill them further down to which one should I spend time on, and so forth. Because I agree with you. I mean, I've personally, one of the reasons I've kept doing this so long is that I enjoy working with the entrepreneurs. I enjoy trying to help them build their company, trying to, be supportive in whatever ways I can based on my experience. That's why I do this. Obviously, you do it to make money and all that sort of as well, but there's lots of different ways to make money. This is what I enjoy doing. It's sort of helping new technology come to market, work with great entrepreneurs and so on, and try to help them be successful. So that's how I've chosen to try to make money. And so I invest in a way where I have the time to do that. And whether it's me being proactive or them reaching out and saying, hey, could you spend some time with me on this? usually those are the types of things that you walk away from those conversations feeling invigorated and excited, and and so on.
I love that. And you know what? There's even in the angel world, I would say it's kind of like a part-time role for most angel investors. They're running their own thing, and this is a way to give back. But I guess I have another spot for the people that spend all of their time working with startups, investing in startups, and that's their role. Because, and I think we may have chatted on this before, but it's the only job in the world where you can help push an outcome, and you're paying to be there. So you don't get that in very many choices in life, where you're paying someone to be part of their road trip and helping them grow their company. So the furthest thing from right now today is that one day this is going to pay me back, but I'm going to work my butt off to help these guys go from A, B to C. And when that happens, there's going to be a great outcome. So it is a strange model when you think about it. But those are the people that put all the hard work in to help. And that's where you're going to get the best outcome. And which kind of steers into my kind of next question, which is, statistically, and the whole reason on our end we started a lot of this was because the stats to me make no sense. They drive me crazy. And that is that 1 in 10 companies will win. And I think about that. I'm like, who wants to work and invest in this stage if every company has a 9 out of 10 chance of failing in the first year? I'm like, this is ludicrous. And there is a lot of interest, and like you shared earlier, not a ton. Not everybody is wholly focused on just angel investing, but all the way up the funnel, companies are failing at all different stages. And it's the data is mixed on why they're failing and where the fails are coming in. But if you took from your VC side and the Series A onwards, do you have some high metrics that is it 7 out of 10 companies have failed? And you're hitting the standard 19 to 22% IRR returns. And then on the angel side, you're kind of just working through that because it is earlier. So 1 in 10, does that mean I got to invest in 100 companies to get myself 10 lucky, great companies? Or because of the passion and time you put in, you're able to change a lot of those outcomes, which they do share that more active angels tend to have a lot better portfolio. But just from what you've seen to date in the 20 years that you've been heavily focused in this space, any metrics that you can share that kind of shed a better light on what you've been able to accomplish or your funds and businesses have?
Yeah. Well, so yeah, I mean, the data I've seen would say overall, Series A and beyond, there's still it's not 90%, but it's still pretty high. It's probably somewhere between 50 and 66%, right? Between half and 2/3 that will lose money. Will they lose all of your money? I don't know, but you're not making money, right? And then there's a more meaningful chunk or a decent sized chunk that's doing sort of 2 to 5x, and then a relatively small number that are sort of 5 to 10, and then a tiny sliver that are like 10x, 100x. The thing that you do have to acknowledge, right, within any early stage investing, whether you call that Series A, seed, is that typically, the power law exists, and a small number of deals end up driving a huge percentage of your returns. And if you can't get in any of those big returners, your overall performance is not going to be all that great. And that's why the average individual deal loses money. But if you have in that portfolio 1 or 2 that do really well, it makes up for it. I've seen data from different sources on. Oh, and by the way, our venture fund. So our model was always to invest, in a way. And that's why we focused on sort of revenue stage and on enterprise and on sort of somewhat experienced entrepreneurs. And we wanted to invest in that sort of A-B range company, but greatly reduce the number of failures. And we were able to do that, right? And it's one of the reasons we were successful is that for us, instead of half to 2/3, it was more like 20 to 25% that lost money. And so you had much less of a hole then. And we still had a healthy percentage. It's sort of in that middle part. That was the biggest bucket that sort of, 2 to 5x, but you would still get a few that really did well. On the angel side, I've seen data from AngelList that suggests, including all of their fees and everything, which are high on AngelList, I think they see average angel returns of about 1.5x. I've seen studies more broadly and more generally that say you can do, better than 2, sort of 2.5x. And then I've certainly seen angel groups who show numbers that are far better than that as their overall portfolio. So I just really think it does depend on the approach that you take and whether it's sort of an index or a more thoughtful and focused approach. I think a lot of individual angels will, when they're honest with you, will sort of muse about, is this really the best way to make money? But they do it because they love it, right? And they love working with companies. They love sort of making that bet and kind of, to some degree, betting on the founders, on those people, and then really trying to help them be successful. And for them, there's value in that, right? It makes them feel alive, and so they want to do it even if it's not necessarily. They don't want to lose money, but they don't. Making money is not the only goal, right? So.
Totally agree with that. I think there was an article that came out not too long ago that was something like entrepreneur equals psychotic or psycho or something like that. And I would take it one more step and put it that equal angel investor is the same. And because predominantly most angel investors that I would say that I've worked with or come across, they tend to be entrepreneurs. And maybe we throw a stat at 75% of them are entrepreneurs. Well, if that's the case, then they're just as bullish and crazy as the entrepreneur would be, which on the risk side, it's on the highest end. So they're going to be looking at, I love doing this. I'm passionate about this because my outcome is that I can affect the outcome. If I invest in Apple, they don't care what I have to say, unless I'm Aikman or someone like that is putting in hundreds of millions of dollars into a company and they can move the dial a little bit and they have a say. But earlier on, that's where the investors get that most opportunity to shift, change, and build that company. So from a risk standpoint, it's quite high, but I think it also means that every day I'm part of that risk. And I think that risk is really what drives that angel investor to keep wanting to invest because they see the potential outcome and they're hoping for that and they're trying to work the wheel to get it there. But if it fails, they've already got 400 other irons in the fire and they're going to continue to work those angles because that's where they're getting that energy every day from.
Yeah, no, exactly. And, it's sort of I think there is a balancing act for whether you're an angel or an early stage VC or whatever. You do this because hopefully you get a lot of energy, right, from working with entrepreneurs, working with early stage companies. And, it's what gets you excited to get out of bed and so on. And that's very much true. It's very much true for me. It's very much true for people I work with. But you do also have to realize they're just not all going to work out, even if you want them to, right? And that's why you do have to have a portfolio. That's why, to some degree, you have to play the numbers game. And you have to be willing to accept that some of the ones that you love and some of the people that the stars just aren't going to align. And you have to be willing to let go. And that's okay, right? And certainly it's not the fun part. It's not sort of what you want to have happen. But I think you have to sort of accept I'm playing this knowing that it's going to. And so I have to be thoughtful around. This is especially relevant for those that think about doing follow-on investing, right? You should be driving your follow-on dollars to the ones that really do have the most promise. And you should be really limiting your dollars to those that haven't, shown any momentum or progress or for whatever reason, right? And you have to be pretty disciplined about that because it's usually the opposite of what's going on. Like usually the ones that are struggling are the ones that need more money, and the ones that are doing really well, they can get money from almost anywhere. So it's a lot easier through inertia to put more money into the bad companies or the lower performing companies, which is the opposite of what you should do. And so again, something that you need to be aware of and kind of purposeful about is sort of, should I be putting more capital into these companies? I know I might love the entrepreneur still, but have they made the progress, right? Very few people hit every goal that they have, but have they shown enough progress to kind of deserve this? And I think those are the judgments, frankly, that in some degree is almost harder than the initial investment is the follow on. And that's where I think having a lot of experience and judgment can be very helpful. And that, so that's where I think you have an advantage when you've done this for a long time to some degree.
I love that. I was taking down the line you said by judging your investments. I think that you're right that there's a lot of disconnect on how harsh I review the companies that I've invested in. And sometimes I remember one time at a angel meeting, they were talking about a founder, and I kind of, with the context to it, but I remember it's probably the only thing I've ever said at an angel group. And I said, look, you're not here to pay for friends. You're here to invest in companies that are going to grow. And, maybe that was shocking to hear, but I think a lot of the time you're looking at ways to tie yourself into the business, tie yourself into the founders and build that friendship. But really at the end of the day, you're there to guide, help, and support. And when it comes to that reinvestment, they're going to knock on your door. And then the guilt or whatever reasons are that force you to invest aren't the reasons that should be, which is based off of the metrics, the numbers, and where that company is sitting. And I think we don't scrutinize things enough because we've built ourselves into this comfortable, more of an emotional connection into what you're doing, that you forget that this is a numbers business. And at the end of the day, your portfolio needs to work, and metrics are the only way that it's going to work. So you kind of have to push that line. Like, don't get me wrong, there is always going to be some formula of matching of emotion and connection into the founders and the team. But at the end of the day, it's if you're a VC or you're an angel, it still comes down to, how do I value where the company's sitting? Did they hit the KPIs? Do they still have the scalability and growth opportunity they had 2 years ago when I invested? Or am I just throwing my money away at this point?
Yeah, no, and I think it's very hard. And that's why I totally respect people who take the angle of, I'm only writing the first check. I'm going to take that question off the table, and be disciplined about it, because I do think it's a very hard decision. And you may know more, but you may not know a lot more sometimes when they come back for second or third rounds. So anyway, I think to me, that's it's because of the emotion that gets tied in as you build a relationship. It's sort of a very interesting discussion, and that's where it's really good, I think, to have people that hold you accountable, people, partners or whatever, that hold you accountable. So.
How do you be direct without being cold?
Yeah, exactly.
There's a lot of things that go into that relationship 101 side. So
padded 2x4 was what one of my mentor used to call it.
Patty, what is it?
But do it in a very polite, professional, constructive way.
Yep. I love that. All right, well, we're going to kind of shift our way through. We've got some rapid fire questions that we're going to ask, but and maybe this one question is just focused on kind of some startups. And again, with your depth of experience, I'm looking for kind of like a story that she or he has gone through in your entrepreneurial journey that you see these companies and you just are amazed that this company should have failed. They didn't. They skyrocketed, took off the map, whatever it might be, but just what it shows to be an entrepreneur.
Yeah, I think of one of I won't name the company because it's still an active company, but company has Israeli founders, and had agreed to sort of move to the U.S. They were in the mobile world, which moves really rapidly, right? And they grew really quickly for a while, but then that market started to change. And I was just amazed at how quick they were able to pivot to some degree. I mean, not like a totally different business, but leverage what they've done and point it in a new direction and continue to make really good progress. And then they did it again a couple of years later, and they basically turned their entire business into more of a data business. And it's now probably the healthiest version of their company they've ever had. The margins are high. They continue to grow rapidly. And so like, it's been very impressive at the ability of this entrepreneur and of the team around him in this case to sort of read the market, make the call, and make the adjustments and to keep going. It's hard to do. And like, watching someone do that successfully twice is amazing. So it's been very inspiring, right? And just the fact that they were always willing to question what they were, are we doing the right thing? Are we delivering what the market needs? Should we make a big change? There's a lot of people who don't have the guts to do that.
I love that. And I think I read somewhere that entrepreneurs, ones that are, and I can't remember the term it was, or very forward thinking, is that if they're not blowing up the industry and trying to change the way it works, they're going to blow their company up because they do this in a good way, but they're doing it because, I don't know if it's boredom, but they're always trying to change the way something looks. So you're going to fix and be mindseted on changing an environment and selling more. And then once you start to make that shift, now it's internally. How do I keep shifting and changing and fixing and automating and making things better inside? So that would go back to our earlier discussion around following the trends and better understanding the market. And I used to use the term that I invest in psychotic founders, but people took that the wrong way. So I've had to dull that down. But it really does come back to people that really understand their space. And it sounds like this founder did. So that pivot wasn't probably anything that was shocking or off the wall, but what it did do is it allowed for that founder to be always continuously learning and building in the space so that when they needed to make that change, it was kind of seamless, and maybe it wasn't as stressful on the second time as it was on the first. And they may continue to do that, but they found their space, which is phenomenal.
Yeah. No, again, the ability to sort of, where a lot of people would be like, what? We're doing pretty well. The ability to sort of say, we can throw that out, right? And do better. And we have to adjust because this market's going to change. Like that's just, there's an incredible amount of, some people might call it a little crazy. So your word psychotic isn't completely, but like if they hadn't, their business would be way worse off now, right? It probably, it might be out of business. So the fact that they were willing to sort of, to some degree, cannibalize or give up or sort of, totally shift their old business away was, as I said, sort of took a lot of guts, but it's because they felt like it's what they had to do, right? It's what made the most sense. So again, I think status quo, right? You can't be someone who enjoys, things that are comfortable and things that are kind of make sense and are steady. I think in order to be a great entrepreneur, you have to be constantly questioning status quo, even your own, right? So.
Agreed. I love it. All right. We're going to jump into our rapid fire questions.
Let's see how I do.
All right. So it's pick one or the other. All right.
Okay.
First one, founder or co-founder?
Founder.
All right. Unicorn or 4-year, 10 times exit?
I'll go with unicorn.
All right. Tech or CPG?
Tech.
Brand or tech?
Tech.
AI or blockchain?
AI.
First time founder or 2-3 times founder?
That's a tough one. I've probably had better luck with experienced founder.
Okay. First money in or Series A?
I'm doing more first money in these days.
All right. Angel or VC?
Yeah, Angel.
And this question is always different on each group. But in case you play in both fields, so it's fascinating because you have to actually pick between the two. So, board seat or observer?
I'll take observer.
All right. Safe or convertible note?
No.
Lead or follow?
Well, I've done both. I mean, as an angel, you're typically following.
Equity or interest payments?
Equity.
Favorite part of investing?
Seeing it work. Seeing the entrepreneur proven right and you proven right.
Agreed. Number of companies invested in per year?
Well, so as a VC, it was, sort of like 4 or 5. These days, though, it's more like 15 or so.
Okay. Preferred terms?
For term, I mean, I like to invest in equity. And so, but beyond that, it can be fairly straightforward. So nothing too fancy.
Okay. Verticals of focus?
Most of my experience is on the B2B side. I've done a lot in things like AI and data analytics and security. So that's what I know. That's why I'm most comfortable.
Okay. Startups. On the startup side, what makes them stand out the most to you?
It's usually the founding team, people who are truly compelling and that you just feel like, God, I want to invest in that person. Sometimes it's, there's a really, really special kind of business model, but it's usually the people.
Okay. All right. Now we're going to jump into the personal side. Same thing. Book or movie?
A good book is, it's hard to beat, right? You lose yourself in
Superman or Batman?
it. Superman.
Pizza pop or ice cream bar?
Ice cream.
5 minutes with Bezos or Oprah?
Oh, I'd probably go with Bezos.
Arsenal or Manchester United?
Chelsea. That's where I used to live.
Nice. I'm trying to find Arsenal fans. I have found one the other day, so that was all the
I have
interviews.
nothing against Arsenal. I used to live in Chelsea.
I actually watched a Chelsea Arsenal game. I watched Chelsea play and Chelsea. This is 3 years ago. So it was pretty awesome. This is when they rocked and they were amazing. Oh, the year that they were doing not so great. And the fans, it was so boring. They were just like, Chelsea. I think everybody was so mad.
There's no heart in it.
Yeah. So, all right. Bike or rollerblades?
Bike.
Big Mac or Chicken McNuggets?
Big Mac.
Trophy or money?
Money.
Beer or wine?
Beer.
Alarm clock or mobile phone?
Alarm clock.
Hotel or hostel?
I think I'm past my hostel days.
All right. Based on all the things that have been happening with Trump, does he go to jail this time or is he free? Yes or no?
Yeah, I don't think he'll end up in jail. I don't know. He certainly deserves something, but I don't think it'll actually play out that way. He somehow slips out of everything.
Yeah, he is a bit of a magician.
He really is. How the fuck did he get elected in the first place? The guy, anyway.
I don't know. The other 100 million Americans thought that it was worth them coming in there.
No, I know. I understand the dynamics that put him in power, but still, like, how is he the candidate? Because he's just anyway.
Yeah, that's beyond psychotic entrepreneur, I guess. All right, last 3 questions. I think I know the answer to this one. Favorite sports team?
Favorite sports team? Actually, It's not what you think. It's the New Zealand All Blacks.
Oh, all right. Nice. Yeah, they're a great team too. Yeah. Okay. All right. I thought Chelsea was coming in, but that's all right. All Blacks are worth watching. They're a lot of fun. They got a lot of energy.
They are amazing. Yeah.
Favorite movie and what character would you play in the movie?
Favorite movie? Well, I don't know. I mean, one of my favorites is called The Natural. And so I'd probably want to play The Natural. Right. Robert Redford's character.
Yeah, I thought that's who that was. Yeah.
But yeah.
Was that a baseball movie or no?
It was a baseball movie.
Okay, yeah, I remember that. I probably haven't seen it in 20 years.
It's
but
a classic movie.
All right,
definitely, it's about as cheesy as they get, though.
All right, fair enough.
When he hits the ball, the lightning strikes, and
oh yeah. Well, I'm sure there's some realism somewhere in there, but that's all right.
Well, there's a lot of like good and evil in there. Like, you know, anyway, it's a little cheesy, but it's a classic.
All right. Last question. What is your superpower?
You know, I think my superpowers is really around sort of bringing people together around, you know, whether it's around sort of new companies or events but I love networking. I love connecting people together. I definitely believe in sort of the wisdom of the crowd to some degree, right? If you use it the right way. I definitely, you know, when done right, I think the whole can be greater than the sum of the parts sort of thing. I'm definitely not someone who wants to try to do everything themselves. So.
I like it. It's kind of like that herd mentality side of things. Bring everybody together, lead the way, and hopefully everybody connects.
Well, yeah, and there's some great, you know, there's been some great recent research on by some of the leading, you know, one of the best behavioral psychologists in the world, Daniel Kahneman out of Israel, wrote another book called Noise, and some really interesting stuff in there around individual judgment, right? Our individual judgments can be widely, you know, varied based on totally irrational things like time of day, weather, you know, what we had for breakfast, all this stuff. And it's actually really scary when you look at some of the analysis that's been done of the judicial system and how outcomes can vary so much on stuff like that. But when you use the wisdom of the crowd the right way, when you use, you know, if you get together a bunch of smart people and you can figure out how to get the right insights, it can get rid of a lot of that noise, I think. So that's just one example of why I'm excited about leveraging the wisdom of the crowd.
I love it.
All right, well, great talking to you, Jeff.
I'm going to look up these books, all of this stuff. But I want to thank you, Matt, for joining us. Awesome conversation. Again, like I have to show, I take a million notes, but lots of great things there. Very insightful. I appreciate all of your time. And what we like to do on the show is to end it by allowing and having you share the last words, which is anything you want to say to the founders or to investors. I turn it over to you. But again, thank you very much for your time.
Yeah, well, I'll just say, you know, keep doing what you're doing. It's great to, you know, get people talking and to, you know, sort of help this ecosystem along. You know, to the founders out there, I guess it's just, I have a lot of respect and admiration for sort of the bold leap that you've taken in starting a business. And, you know, whether, you know, I invest or not, you know, I wish you the best of luck. And it's definitely what drives. I mean, I love thinking about the future, right? And I love thinking about the next generation and all that sort of stuff. And so for me, folks that are trying to kind of make a difference and so on, it's inspiring.
I love it. Well, again, thank you very much for sharing all of this. I think we broke a record for the longest time I've talked on the podcast, but man, there was a lot of great insights. So thank you very much. Okay, that was some great insight shared by Matt, and everything from following trends, building your interest and thesis, you know, getting down to that competitive edge through leadership, diving in, understanding the market, the competitors, and just all over power law, how helpful and important it is for angel investors to invest in the company, even to the book he was sharing about noise, the psychology from Daniel Kahneman out of Israel. Man, just so many great notes that I've got here. But, even the best on his line was judge your investments before you invest or reinvest. Make sure that you're calculating and doing it for the metrics and the numbers. But outside that, thank you very much again, everybody, for joining us. If you enjoyed the conversation, please subscribe to our YouTube channel or follow us on Spotify, Apple Podcasts, or Stitcher. You can check us out at supportersfund.com, or for startup events, visit opn.ninja. Thank you very much and have a fantastic week.